So hello guys, welcome again to our channel, and if you just joining this channel or seeing this video for the first time, I would like you to subscribe, share and like. Now what we do on this channel is we create educational forex content that will help you become a more profitable and a better trader in the forex market. So today we're going to be talking about liquidity and where you can spot liquidity in the forex market and how you can actually apply liquidity into your trading decision. All right, now you need to understand that liquidity are zones or areas that a lot of orders are filled in the market. Now liquidity simply means money, guys. You need to understand liquidity in a short form mean money. All right, now it's money that control this market. And now we retail trader that has all these $500, $200, trust me, our $500, $200, even $1,000 cannot move this market. So the major institutions that actually move this market are the institutional traders, all right, like the hedge fund managers, the banks, the liquidity pools, and the big institutions, all right. They are the ones that actually move this market. So we are just partaking in the market because our money cannot actually move this market. So we need to understand that for us to actually have uh, a high level of success in trading, we should be able to know where this liquidity pool is found in the market as a trader, which is the area of interest. All right, area of interest in the market, that where can we spot this liquidity and how can we take advantage of it. All right, so the truth is, if we believe that there is liquidity in the market, which is where a lot of money or orders are sitting in the market, we should be able to spot it and trade along with these hedge fund managers, this bank, this institutional trader that move the market. All right, because it's their money that is actually moving the market. It's not me and you that have $500 or $1,000, like I said. So you as a trader, you should be smart enough to trade along or place your order in where these institutional traders or hedge fund traders are actually placing their trade in the market. Now, one thing I can explain to you is, for after every break of market structure, all right, after every break of market structure, uh, price will always leave some sort of liquidity. So some levels you will need to look for liquidity sometimes are the resistance level or support level in the market. All right, these are some of the major level that you can spot liquidity: resistance level and support level. Now, not only that, after every break of market structure, after every break, okay, after every break of market structure, especially the external, all right, break of market structure, especially the external structure. All right, if you've not watched our video on market structure, please go and do so you understand what we mean by external and internal structure. All right, it's very, very important. So you will spot liquidity very easily if you understand that. Now, after every break of market structure, especially the external market structure, so you will definitely find some sort of liquidity be left in the market, which is area that price may likely come back to in the market, that a lot of orders are sitting, and if you're not careful, if you place your trade before that key levels, you're going to be stopped out. All right, so now let's look at this carefully. All right, we saw how price move here. All right, this low that price swept before we break this structure at this level, here. All right, something happened there. This place was a point of liquidity, maybe from the future market movement. All right, are we able to mark this place for you around somewhere here? All right, because this same place is what we are having as somewhere here. Notice how we broke structure, we created a high, price came back and took out this little level here, this little low that was created here. So if I should expand this a little bit to create it, it's more like something like this before we saw how price did break this level. All right, now these kind of levels that price will normally create, let's say for example we are having a lower low, price is giving us a lower low in the market. All right, and eventually we broke structure. Now sometimes we do not immediately break structure like this in the market. Even if we break structure like this, all right, price will tend to create a certain movement by giving us a low like this before this overall structure here that you see will be taken out, before price will break this level again to create another external structure. Remember, this is our first external structure, and this pullback is our internal structure. Now whenever price create this internal structure, price will sometimes attempt to want to take out this external structure 90 to 95% of the time, and that will fail. All right, price will get to somewhere here, and you will notice something, price will definitely want to come back and take out this low. That means trade below this low before price will eventually expand. I'm going to show you guys that in the chart. So you will see a price will be doing something like this around this level and come back, trade below this low. The moment you trade below this low, you will notice a shift in the market again. All right, you notice a shift in the market before price will eventually sometimes trade above this high. What does that mean is, when price created this external structure by breaking this structure, all right, there were money still sitting in the market, because the institutional traders or the hedge funds, they know that okay, we have a lot of buyers in the market right now, but we cannot put in our money in the market immediately, because they put in only some of their orders. So they want to come back and refill those orders again to push the market to the upside. So they will have to come back to where was the most recent low that was created, which was this one, before price attempt to want to break this high. And at that level, they will also look at it, is this level an important level? More like, is this a discount level? Is price around this level cheap enough? Now if we take our Fibonacci 2 and measure from this low to this high, you will agree with me that this push we have here is a little bit below the 50% of this full movement, because they want to actually buy when it's cheap. They don't want to put in their order when price is still expensive. All right, so they will do that, and when they create this fake move, a lot of traders that are not smart and do not recognize liquidity in the market, they will start buying from this level and put their stop loss around this low that you see here. Now notice, when price first came and they bought here hoping that price will come to this level, price will create a low, act like if they want to go, you will see them stopped out. All right, price will come back, stop them, and take all their stop losses out. And by the time that happens, price will change, and price will now eventually start moving to the up and take out this level. All right, so you need to understand that in the market, the major area that price will come to hurt your stop loss, like this level I just explained to you guys, is where a lot of money is sitting in the market, because they know that a lot of traders are having stop loss around this level. So that scenario I just painted for you guys is similar thing here. All right, we have price came this level at a time, a lot of traders will place their buy order hoping that price will go, or price will come and stop them out. When price stop them out, price will make an impulsive move to create a high. Now a lot of traders will still fall for the fact that okay, price is already moving. They will put in their trade here, maybe when they see this pullback. And notice, when this pullback happens most of the time, if you want to put in the fill from here to this low that created that move or shift in market, it's not up to 50%. So price is not at a discount level at all. But a lot of traders, since they do not understand the concept of liquidity, knowing fully well that the institutional traders only want to fill in their order when price is cheap, they don't want to buy when it's expensive. Anything below 50% is expensive for them, because they have the volume to move the market to the upside. So they want to come in when price is cheap fill a lot of money into the market and push the price to create another higher high. All right, so for them, anything that is not cheap or below the 50% is a no for them. So you, as a trader that is trading this market, you need to understand that most of the time you're going to have a high chance of profitable trade when you are taking your orders after every break of market structure below the 50% of that market. And be sure to wait to see if price will create a scenario whereby after a break of market structure like this, all right, the pullback that is created, just be careful with it, because this first pullback that is created is a trap, is a liquidity pool that is created just to fill in traders that are not smart enough to believe that, okay, after this pullback, price will automatically move immediately in their direction. But 90% of the time, price will not do that. Price will come back, trade below this low, and at that point in time, if you measure most of the time, it will be below the 50%, take out all the stop losses here, and push and create a higher high. Now notice, after every break of structure, and you have price created this scenario, if price will need to come again and break above this structure, sometimes you will notice that this is our lower low, all right, and this is our higher high. Now notice, when price breaks structure, this place that was used as liquidity, price will still come back here sometimes to come and use this place for a liquidity to break a new high. And how will that happen? If we measure from here to here, notice this is the 50%, and this place is serving as a discount or a premium zone and is below 20 something or 30%. So price will definitely, because after this break of structure to create this higher high, the institutional trader will now sell off their order, their buy orders to sellers that are in the market, which are other institutional traders. Sell off their orders, and now those sellers will move the market, taking it back to another premium zone. And sometimes this place that this price created this higher high, if you notice from the sell market side that price first move, this area was actually a premium zone too. So price will not be flowing from premium zones to premium zones most of the time. Now notice what we have now. Price start trading and created all this lower low using this place as liquidity again. Now price will come, take out this place, and we have a market structure shift. All right, having a market structure shift can also give us another possible entry. Once that happens, you will start seeing that price will now create a series of higher highs and do what? Break structure again. Now after that has happened, this place now will now become our lower low. Will now become our lower low. And now the next time price will come down, our higher low. The next time price will come, this lower higher low, price will no longer take it out because it has created another higher high, giving us another external structure move. All right, now once we have that low automatically become protected the moment we have a higher high. Now any other thing that price will be coming down for, it will be around this level you see here, that price will be looking for to take out markets more order again. So this place will serve as another liquidity pool. And notice this place is now another resistance, because when price will be coming down, price will be moving, same pattern, giving us pullback. And when it gets here, take out all the trade that are here, all the stops orders, people that were buying that failed to take out their profits and create all those break even or stop lose and all that. Price will come, take it out again, rehab from this place, give us a shift of market structure, and continue the same movement to create another higher high. All right, so if you understand this, most of the time using liquidity is good. And how do you understand liquidity better? Let me just give you a simple graph again that will not confuse you before we go to the chart. All I'm simply saying most of the time is, before we have a a break of market structure like this. All right, before we have a break of market structure, we have this, and we have shift of market structure. Price will definitely want to create a low and go back, try to take out this high but fail, and come back and take out this low that is created, use it as liquidity, because they know that when this pullback occur, a lot of traders tends to place in their buy order here. Pardon me guys. So they will come back and take them out. All right, stop all of them out, fill in their order, and price will start giving us something like this to break structure to the upside. So this is where you should be paying attention to as a trader. When we have a break of market structure, all right, once we have a pullback, first, do not be in a hurry to want to trade this pullback, because this place will be a point of liquidity whereby the hedge fund and institutional traders may likely come back to come and take in their trade. And sometimes, if you notice around this level, you may find a breaker block or a fair value gap around this level. All right, you may find a breaker block or a fair value gap around this level that push this price to the upside. Wait for price to take out this low, all right, that is created. Price will go like say price is buying, but 90% of the time the price will not take out this high, which is the external structure high. But price will not do what? Come back, take out this low, use it as liquidity, because that's the liquidity pool. They know that a lot of orders are sitting here, a lot of traders have entered the market, but it's not discount or premium enough for them to fill in their order, which is the hedge fund, the banks, and the institutional trader that have this large capital that can move the market. So they will come, stock out all the people here, taking their orders, fill in their order properly to create another higher high. That means to drive price to the upside. All right, and once that happens, you will see price change. Now, another way you can know that, okay, after price has broken structure, where is the next point of liquidity? Now, before price will break structure, which is taking out this high, price will definitely sometimes create this kind of movement here before price will break to the upside. Now, notice when you see that and you see that, you cannot use somewhere like this now, which is this breaker block, to be your next position for another possible entry, because this low that created this high will now become our higher low, and most of the time price will not trade below this low. All right, but which low can we find before price broke structure? This very low that is here. So price will definitely want to do what? Give us a pullback, trading to this very low, which is this one that gave us this one. Price will trade, take it out, bounce on this breaker block, give us a shift of market structure again, and what do we start seeing? We start seeing price trading to take out this high. Are we clear now? All right, so if you're finding this video interesting and you are learning something from it, if you understand this concept, most of the time you're going to be having an amazing and profitable trade, because you are not going to be used as liquidity, but you are going to be trading along with the hedge fund and the big institutional trader that are controlling this market. Now let me go to the chart and show you guys some of these examples. So we're going to go randomly to the chart, and maybe probably we look at this from the 4-hour time frame. All right, let me look for a clean chart. I've marked so many lines there, so let's do something. Let me use a chart that I've not used before. Okay, that's the same chart. All right, so let's look at this chart. It's clean. Now first we're going to look at where price broke structure and look at what happened. Okay, so let me zoom for you and show you guys. So you notice at this point in time we broke structure here. All right, so if you come to this side now, you saw how price traded and created this high. All right, and we have this high. Now one thing I want you guys to Now let's look. This was the low that created a high. All right, so we have from here to here. All right, now let's take the fib and measure. I want to show you guys something. Notice this is the 50% line. All right, and now below this 50% line, what do we see? We see this low and this low, and this low was created before price broke structure to create a high. So if we should extend this now, do the price get to that level and reacted from it? So let me mark the 50% for you guys. This is the 50% line. All right, do you see that the price traded back? And we'll get to this level. Now remember, this is where we have our previous higher high here, and this is our higher low before price break to give us this high. All right, now price traded all the way back below the 50% of the Fibonacci 2. Remember, I told you guys that the hedge fund and institutional trader, they do not want to take their orders or take their trade when price is way expensive. They want it to be cheap before they can get into the market. All right, they want it to be cheap before they want to fill in their order, because they are the one that has the money to move the price to take out the structure that was already created before. So let me delete the fib so the chart could be neat. All right, so you saw how price traded by filling this order. After that, we saw a shift of market structure and we start seeing price breaking structure. Now notice we broke structure here, and notice after break of structure, price created a high, which is this one. All right, notice this low was created. Notice I told you that after every high is created, price will intend to want to go fill and come back and take out that low before price will expand. And you saw how this one happened around this level too. All right, so sometimes what you need to understand is it's not going to be happening for you 100% perfectly, but if you can spot these places in the market whereby price broke structure, before price broke structure, like this case. Now let me give you another example here. Notice this high here. Notice here. Notice when we broke this structure and created this high, like I've showed you now before. We saw how price did what? Created this low, came back, took that low out, reacted, and we went and break high, and we created another high. All right, so you need to just make sure that you train your eyes to see this happen. Notice here, we broke the structure here. This low was created before we broke the structure to create a high. Price traded back to take out that low. Can you see it? Pull back, take out this low, and we went up. Now if I should take this fib and measure from this level of high to this major low here, it was still below 50%. Let me just mark this line for you so you can see. So the moral of this class is you making sure that after every break of structure, first allow price to pull below 50% of the Fibonacci retracement 2. Not only that, if you can see a break of structure, and before that price broke a certain structure, there was a low created before the price broke the structure. If you take your fib and measure that high and low, you have your 50%. That very low is very, very high. There's a very high probability that price will trade to that certain low, and from there you can start to see some sort of market shift. So you need to understand that liquidity are measured zones or pools whereby we have a lot of orders sitting in the market, and most of the time they are always found below the 50% retracement after every break of market structure. After every break of market structure. So once price broke structure, that pullback that you're going to be seeing, that is going to be below 50% on the Fibonacci 2, the low that is created below that 50%, 90% of the time, that is where the liquidity in the market is actually sitting, and that is where a lot of these hedge fund and institutional traders are going to be taking their orders and move the market to create another high. This is another example here. We saw how price broke structure here. All right, now notice before we broke structure, we create all this low here. You can see it here. Now price have to do what? Trade back to take out that low. And what do we see? We saw how price did what? Created another high. All right, so if you measure from here to here on the fib, if you take from this very level and here, the pullback was also below 50%. See our 50 line? See that before price take out that high, we have all this liquidity sitting here. Price pull back, take them out, and we see this expansion. All right, you can see that if you want to zoom out. All right, so you can train your eyes to look at these areas. I don't actually, stress myself most of the time, because I have my strategy that work for me, and whenever I spot this liquidity in the market, I actually know where it is, and I only look for the premium and discount one, not like every traders that's in the 1 hour time frame, 15 minutes time frame, they are marking liquidity everywhere. You're going to be confused, and you're not going to be having good entry. You want to be able to trade in this market whereby your entries are great entries that are actually lining up with the hedge fund or institutional trader that are actually pushing price to a higher high. All right, so if you find this video interesting, you were able to learn something, leave us your comments, and also subscribe, share with people, and see you on my next video. Thank you.